So in today's video, I want to talk about how to choose the right whole life insurance policy if maximum cash value is your goal. So this video is actually based off a case study. Someone had recently reached out who has experience with whole life insurance. The husband had reached out and he mentioned that he has a whole life insurance policy with Guardian and he's got experience with it and he understands it to a degree. However, what he also mentioned in his email is that he's interested in another policy, but with an emphasis on high cash value. He wanted to get as much cash value out of the policy from day one and then throughout the life of the policy, day one through forever. Now, he's interested in a policy for his wife, who is 39 years old at the time of preparing the illustrations when she's looking to start the policy. And again, he wants Guardian, but what he had asked for was funding a policy somewhere between 10 and 15 years, and he knows the exact dollar amount that he's interested in paying into the policy. $25,000 per year. So if it's $25K per year for 10 years, that's $250,000 going into the policy. If it's another 5 years, 15 years, that's a decent amount of money that's paid into a whole life insurance policy. What I want to hit on in today's video, though, is based on this request. We showed him this. I'm going to go through exactly what this looks like. But knowing the rules of the game, meaning the limitations that are set by, one, the IRS with respect to the MEC limit, but two, the specific insurance company that I'm interested in taking a policy out with, it's very important to be aware of these limits. Because how Guardian works is if I want to fund a policy with maximum cash value, minimum expenses, minimum premium, I'm going to talk about exactly what that means. But if that's my goal and I want to fund it for 10 or 15 years, the design of that policy will be different from day one. Whereas some other companies, like MassMutual, for example, I can design a policy in an identical manner and fund it for 10 years or 15 years, or I can keep going longer and I do not need to design it any differently from day one. Meaning, after I've started, if life happens, I can pivot as time passes. Now, there's pros and cons to different companies. Guardian is one of my favorites, but if I want the ability to fund it for a long period of time, there's some things I want to be made aware of. When I say I would want to be made aware of, I mean, if you and I flipped positions, if you knew everything about the product, I would like to know what you know. Tell me the important things. Don't just say, okay, you want to go 15 years? Here you go. Say the policy. See you later. Like, no. Let's get it right. And then, of course, we continue to work with you as the years pass. So let's get on into it. He was interested in a policy for his wife with Guardian at that $25K per year for somewhere between 10 and 15 years. So he's not sure how long he wants to pay into it, but he knows the number and has a general idea of how long. So when it comes to paying money into the policy, he can pay money toward one of two areas. This is the most important thing to be aware of. He can pay money toward the insurance premium dollars with this policy that we're going to look at, which is Guardian's L95 product, do not show up in cash value in the first year. Beginning the second year, guess what? We do see those premium dollars show up in cash value. But in the first year, I've got a goose egg. I've got a couple dollars, but it's next to nothing that shows up based on the base premium. The reason why is because the premium dollars primarily satisfy the death benefit up front. Whereas PUA dollars, this is what everyone's always interested in, money I pay here, I see show up in cash value. And this is money I have access to, begins earning the guaranteed rate, really accelerates the cash value growth. Right out of the gates, I'll see somewhere between 90 and 95% of that payment show up in cash value. That's in the first year, money he has access to. So just with this little bit of information, if this is you and you know, okay, if I'm going to pay $25,000 per year into the policy, or any dollar amount for that matter, and money I pay here does not show up in cash value, but money I pay here does show up in cash value into this PUA rider, where do you want to put your money? Well, the answer we always get is, how do I put as much money as I possibly can toward this PUA rider and minimize the premium? Back to the rules of the game, having awareness around the limits that different insurance companies have. We can set this premium just about at 10%. We can actually set it a little bit lower. I'm going to go through the exact dollar amount in this example, but we can set it at 10%. So for the sake of this example, let's say your premium is $2,500. That means the other $22,500 is directed toward PUAs for a total of $25,000 per year, which is a very cash-rich policy right out of the gates. I'm also only committed to the premium, so now he has a ton of flexibility. He can commit to a minimum amount and add up to $25,000 per year, but he's not obligated to pay that $25K. A lot of people like that for flexibility reasons. So, with that minimum premium, you're going to see some other things as we start to look at the numbers here. I can have a policy where I can pay $25,000 per year. I can have this minimum premium of $2,500, but I have to have a rider attached to the policy, particularly a term insurance rider. Let me show you the differences here, one just with the comparison, and then we'll look at the actual illustration. So here's a policy for his wife, a 39-year-old female, ultra preferred. She did receive the top health class. And as we look at the scenarios here, so I wanted to illustrate a couple different scenarios with Guardian. One, what he requested, $25K per year for 10 years, and then $25K per year for 15 years. What do you notice here? If we just look at the first year, $25,000 in, what's your cash value look like here? $20,872. What about the example where you pay for 15 years? Cash value is a little bit less, a little bit more than $100 less in the first year, $20,755. Now, often the reaction we get here from some is, who cares? It's a minor difference, doesn't really bother me. But then some ask, why? Why is there a difference here? What is the impact on this policy, or it can fund longer? What's the impact, or why is it giving me less money up front? Well, look at the death benefit. $1.2 million. What's the 10-year funding example? $850,000. We even ran an option here where we paid into it for 5 years. What do you notice here? Cash value is even higher up front. Death benefit's lower though at $570,000. So the reason why is Guardian, as a life insurance company, they allow a policyholder to pay 10 times the base premium in PUAs every year as long as a 1-year term rider is attached. Should rephrase, that's the maximum dollar amount we can illustrate being paid into a policy, with the exception of the first year, where we can actually pay 50 times the base premium in PUAs. But here's an example. Here's the 5-year funding option. Let's start with the 10-year, actually, because what he requested was 10 to 15 years. Now, first question, if this is you've got $25,000 per year going in, or if it's $250,000 per year going in, my question would be, where is the money going? This is if you and I are relatives, you're working with an agent, I'm saying, and you're asking, hey, what should I look for in this illustration? Here's what I would look for. Say, okay, you've got $25K per year going in. Where's that money going? Money can be directed toward the insurance premium, which is right here, kind of an oddball number, or toward what? Look at that, paid up additions rider. That is that PUA rider we mentioned earlier. Now, in this particular example, this base premium is at this oddball number. I like round numbers, but that's not a round number, obviously. Where we came up with that number is if you look at the PUA payment, it's exactly 10 times that base premium. So Guardian, as a company, the maximum we can illustrate each year is whatever that base premium is times 10. So that's where we came up with that number. Really what I did here was take the base premium, or the total desired payment, and divide it by 11. That's where I came up with that base premium. Now, there's a couple other details here. We've got a term insurance rider attached. OYT stands for 1-year term. It's $234. That's the cost in the first year, which that $234 comes from the PUA payment. Now, here's the actual term insurance rider, $720,000. So when you add this 128, which is the whole life policy that is purchased from the base premium, add the whole life to the term, guess what number you get? $850,000, which when we scroll down here, look at the far right, And what do you see the net death benefit at? $850,000. So the purpose of that term insurance rider does two things. One, it prevents a MEC, which is that taxable event on a life insurance policy. But what it also does, so right here we see it, 1 year term rider. What happens with the whole life insurance policy is as you add money to PUAs, which is where this individual wanted to stuff as much of his payment as possible, PUAs maximize the cash value. That's what beefs up this cash value. This is why we see almost $21,000 in the first year. What PUA payments also do is buy you more whole life death benefit. So that whole life death benefit, if we go back up to the top left, that started out a little over 100 grand, what happens as time passes is as you add PUAs, the whole life death benefit increases. And as that whole life death benefit increases, your term decreases. And the death benefit over here does not change. So purpose to the explanation of the term rider is as follows. We can 10 times the base premium in PUA payments, which is exactly what we're doing here. Here's your base. We're paying 10x that in PUAs, which gives us a net payment of $25K per year. We can do that as long as this term rider is attached. And the term rider will eventually burn out naturally, or we can chop it off after 7 years. Once that term rider falls off, we can no longer pay 10x our base premium into PUAs. We can, but the insurance company will likely require medical underwriting, which is kind of a pain. We don't want to have to do that. We want to avoid underwriting and add funds at leisure. A nice thing about Guardian is he can just pour money into PUAs anytime that he wants. But in this example, when he requested, can you show me the policy, Steve, at $25K per year for 10 years? The answer is yes. Now, what if time passes and he pays into it for 10 years, but then he says, hey, can I keep on paying money into it? Well, the answer is yes, but you cannot continue to pay $25,000 per year. It's a reduced amount. We could easily pay the base premium. Here we cut it off with a reduced paid up, but we can leave it on and he can continue to pay the base premium. He can add some money on top of that in PUAs. If you'd like to see specific details, I would check out our All About Guardian video, which goes through all the details with PUA limits and such. But he can continue to add money, just not the full $25K per year. If he wanted to continue, let's say for 15 years, what we need to do is make sure that there's enough term here. So what we did, remember that death benefit on the Excel spreadsheet? It's $1.2 million for the 15-year example. So what you'll notice here, where the money's going, look at this. Premium is the same dollar figure. So I don't want to increase the base premium if I do not have to, because that takes the biggest bite out of your cash value, especially up front. Why people typically do not like whole life insurance is because of the upfront hit, and the less the cash value is upfront, that's typically a result of the higher the premium is. That's also where insurance companies and agents generate the most profit. That's where commissions are primarily paid off of, the base premium, which makes sense. The lower you set the base premium, the higher your cash value is if all things are equal from a payment standpoint. With traditional products, some products function differently. But when we look at this, let's scroll down a little bit. Let's capture it. So premium, same dollar amount. Whole life death benefit, initially, same dollar amount. Larger term rider though, almost 1.1 million. Add the two together, you've got 1.2 million. So as we look at this guy, the only difference here is that we've added more term insurance, which gave us a permission slip to be able to 10x the base premium for a longer period of time. Now, what he can also do in this option is if he says, you know what, I picked the 15-year option because I wanted the ability or assurance, I should say, to be able to pay in $25K per year for 15 years. But after 10 years, let me stop. Can I just completely cut the term rider and stop altogether? The answer is yes. So we can chop off the term rider. We can eliminate the premium and stop payments altogether. The drawback is if I could go back in time, I would have picked the 10-year option, but I just want to see the different values or the different options side by side before I start a policy. But here, so again, policy just where I'm funding it for 15 years, it looks pretty good. But the main thing I wanted to show him here was when we look at the different options, let's look at the 5-pay. Same base premium, identical here, but lower term rider, and only funding it for 5 years. You can stop earlier than that if he wants to. Look at your term rider, dropping quickly. He could get one more payment and fund it for 6 years in this example, break even year 5. But this stuff is so important to see up front, just so I can see different options and select the one that is truly in my best interest. So when we look at this, like, what's the actual difference? Well, if you're a stickler for the break-even point, like me, and I like a clean, round number to know when I'm breaking even, for example, look at the 15-year funding example. I've got a larger term rider, so the term rider, because I have more insurance, it costs more naturally. And how I like to view it myself is I'm buying the ability to pay into it for a longer period of time. But that cost doesn't make a huge difference in the first year, right? When you look at it, it's $200, $210 in this example. However, year 5, you've paid in $125, and you've got $123, almost $124. So you're not quite there. Again, some look at this and say, I'm just about there. I'll count it year 5. Some say I'm not there when I look at it. And it's completely up to you and how you view it. In my opinion, I as an agent or any agent should not tell you how you should be looking at a policy. It's your money going into a policy. We want to take that into consideration. So here, year 5, you're just about there. And then year 6, you're positive. And there are products where you can easily get it between years 4 and 5. But let's scroll to the left. Same thing here, so close at year 5. But then in the example where we fund it for 5 years, we are positive in year 5. And he can keep funding it afterwards. Maybe it's not at $25,000 if he keeps paying in $5K per year. That's no problem. So you can keep funding it for some time, maybe just the base premium. But my point is, we see a difference there. So this kind of stuff, while the difference might be minor to some, it is beneficial to see up front. A lot of times when we work with real estate investors or business owners, they are attracted to options where they can fund it for a short period of time or have the option to stop. Maybe they want the ability to keep going, but they say, let me stop when I'm ready. So we see different options just based on the rules of the game, the limits, which are, in this particular case with Guardian, that term insurance rider. If I want to have a minimum premium and be able to plow money into PUAs, I do need that 1-year term rider attached. If I have that attached, Guardian allows individuals to throw money into PUAs all day long. I've got my policies with Guardian, the ones I have with Guardian set up like that, and individuals we work with have been doing it for a long time. It's a really neat feature, and I like how they allow that. But with that said, if I want to fund for a long period of time, that awareness is important. The sweet spot, in my opinion, with a Guardian policy is attaching a 1-year term rider, the ability to 10x, call it for 10 years or less. This way I'm not going too high on the term cost, hit a break even of year 5. We could get it in this example with a couple tweaks. Are we at Preferred Plus, actually? We are. So to make a couple tweaks, we're just about there. Let's see if we can work that. Some products will give us that. My point is, dropping the term rider or starting out with a lesser term rider does allow us to break even earlier, which is nice. Now, in addition to that, if somebody really wants to see the difference here, like what do the numbers look like? Well, let's take a look at the numbers and see what the impact is on our internal rate of return. So the IRR, we can pull from the insurance company software. We also have our own formula for annual and average, which over the years, people have been very nice and have shared their knowledge on Excel with us. Check this out. There's my IRRs. I love how they always match up with the insurance company's software as well, because they have to. But it's just a quick overview here. Here's my annual IRR. And here's my average IRR. And then what we can do here, use some copy and paste skills. And this is great for on-the-fly examples, so we can just see what the numbers look like real quick. Of course, anytime you're looking at IRRs, my recommendation is to have them in the full illustration. Very important. Excel is great, but for compliance, we want everything on the full illustration too. And one more to go. There we go. Wrap this up. Pretty cool, right? How we can just pull those IRRs there. And this does really help individuals make a decision or refine their decision-making process. Really all we're doing is providing information and helping guide people. But now I see it from a percentage standpoint. How much does the term rider hurt me? Not a whole lot, really, when I look at it, especially if I look at the cash value difference. Well, I can't look at the cash value difference because I'm paying different amounts in. But if I look at, let's say, year 20, what's my actual difference? The annual IRR, we won't see any difference. Not after we go reduced paid up. But looking at the average, there's a difference there. Typically, if you fund a policy for a short period of time, you will see something like this. The higher the IRR is for a shorter funding policy, shorter funding period, the longer I want to pay in, I'm getting more money into the product, so you will have more money naturally, but you'll see the IRR drop. That's typically always the case with life insurance policies, isolating the average internal rate of return, that is. And that's interesting to be aware of. I've seen so many cases where a lot of times people want the ability to fund a policy for a long period of time, but they do like the idea of getting a lump sum of money they have in cash or another asset into a policy. They look at it and they say, you know what? I'd rather go with a shorter funding policy. Let me try to get more in over a condensed period of time because I'm attracted to the idea of a higher IRR. And then some go longer, just knowing that, hey, I'll take a lower IRR on a higher dollar amount. Again, ultimately up to you. I'm going to provide the information and help you refine your decision-making process. But there we go. And then what we also showed in this particular case, in the event he wanted more flexibility, particularly on how long he wanted to pay in, here's a MassMutual option. So with MassMutual, what do you notice here? We've got a 5, 10, and 15-year funding option. But look at the first year. 22,465, 22,465, 22,465. Death benefit is identical as well. In fact, if we look through the 5th year, the death benefit's identical all the way through because it's the exact same policy and we can adjust the funding period as time passes. So MassMutual is a great option if I don't know how long I want to pay into it, but I want an option where I've got a 10/90 split, that 10% minimum base premium, term rider attached, can plow funds into PUAs. The drawback or the difference between MassMutual and Guardian is Guardian, if we go back to that example, will allow him to commit just to the minimum. And when he wants to add more money into PUAs, he can do that at his discretion. Online portal, mobile app, it's like throwing money into a bank account. Guardian's extremely flexible. MassMutual is not quite as flexible. MassMutual, if you do things right from a design standpoint, he'll be able to make payment adjustments one time per year, every year, provided the adjustment fall on his policy anniversary date. So he's got one shot. So if he's comfortable with that one time per year payment, MassMutual will work well. But it's a little things like that. Have awareness on the limits, know the rules of the game, and you can do a lot of good. So all this shows 5 years, then 10 years. Look at the 10 compared to the 15. Do you notice any difference in cash value and death benefit? Nope, because it's the same policy, just extending the funding. So a nice option to be aware of, just based on what he had asked for in his initial email. Just if I'm him, I'm like, all right, we can do that with Guardian, but he is going to see some limitations. And if he's between 10 and 15 years and he wants that option, he doesn't have to choose one or the other and set the death benefit with Guardian, then this is a nice option to see as well. And then he'll pick the one that he's most comfortable with. Maybe he'll break it up and go with one of each or something like that. That's very common. When we look at the detailed illustration, this is something we go through as well. Very important to do, that is. Breakdown of where the money's going. There's your premium. $2,500. Let me make sure we get that. Perfect. $2,500. We've got term riders, PUAs. We've got videos that break down a full illustration. But there's the total cash value. And on the bottom right-hand corner, we've got this guy, MEC limit $25,000 and change because he wants the ability to pay up to $25,000. So I hope you enjoyed this video. If you did, please hit the like button if you would like to do that. Subscribe for more. If you have any questions, please feel free to leave them below in the comments. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.